back. You're watching The Money Show with me, Kavita Thapliyal. Now, if you have invested in the equity markets, your portfolio may be exposed to several inherent risks. While most of these risks may not be obvious to an ordinary investor, the fact is these inherent risks can often have an adverse impact on your portfolio and may even eat up into significant portion of your profits. And so, on The Money Show today, we will discuss these risks and what you as an investor can do to protect your portfolio. Let's welcome on board Kaustubh Belapurkar, Director, Fund Research, Morningstar Investment Advisor, India. Kaustubh, good evening and welcome to the show. So a very important topic also because for those people who have their goals coming up and, all of a sudden they witness volatility in the market, which is something out of their control totally. What are the kind of events that we're talking about that can have impact on your portfolio just when you're about to use that money to accomplish a goal?
Yeah. Hi, Kavita, and thanks for having me on the show. And I think very, very important topic for discussion that investors need to be aware of in terms of their own portfolio planning for their goals, right? And I think, like you rightly pointed out, when you're very close to, your goal date and, you have a certain amount of money in mind that you would need to use for certain purposes, it becomes almost sacrosanct that you have that money available to you at that time and that the quantum that you need, right? But when you think about investing in the equity markets, we all know great long-term investing avenue, but in the short term, it is extremely, extremely susceptible to volatility, as we've seen in the past. So I think one of the biggest risks that an investor in the equity market faces, obviously, is just your equity market risk that comes about. That if you're invested in the equity market, and history has shown us time and again that the markets can rise and fall quite rapidly, and with kind of huge drawdowns, as we've seen. And in fact, over the last 20 years, we were just doing some very quick crunching. We've seen about 14 periods where the market has fallen almost 10% or more from the peak. In fact, in certain scenarios, even much more than that. But the point being that, if you're overexposed to, volatile asset class such as equity, you are exposed to the equity market risk. And then it can play out in a very wrong way if you're very, very close to your goal. Because, you might have been very close to your desired goal amount, but because the equity markets fall, you could fall below your market value. And that is really what, can play out, right? A much more exacerbated version of that is an event risk that comes out in the equity markets, where something what we call a Six Sigma event happens. And we've seen a few of these in the past. Obviously, we had a global financial crisis back in 2008. More recently, we had the COVID crisis, where we saw the markets fall much more than what we've seen in the past, in excess of 30, 40, 50% in these times, right? Now, just, very, very practical scenario. If I was an investor in the month of April of 2010, I said, okay, look, I want to, invest in equities. I have a 10-year horizon, which is a pretty good period to invest in the equity markets. So, I'll take a safe assumption that I should make 10% in equities, and I plan my goals accordingly, right? Great. But what happened was you invested, say, 1,000 rupees in their portfolio, assuming 10% odd return. In the month of January of 2020, your portfolio would have probably been doing great, above the value of the goal that you needed. And then the Feb and March COVID crash happened, and your portfolio has been significantly eroded. So there's huge significant event risk that can come about, and it gets exacerbated in markets such as equities, which are much more volatile in that sense. Right. So from an equity market perspective, the market risk and this event risk become very, very important things to keep in mind when you're planning for your goal, and you need to plan accordingly. Then we think about the other side of things where, the fixed income side of things, which traditionally is looked at as a much less volatile asset class, right? Which is true. But there can be events even within that which can affect the value of your portfolio. For instance, interest rate risk. We've all heard about it, but it played out in a big way in the last year or so, right? Where the interest rates, rose rapidly. And if you're invested in instruments or funds which have significant duration or interest rate risk embedded in them, typically your long duration funds or, very long maturity funds, the value of that can fall quite rapidly. Obviously not to the level that an equity market fall would happen, but the value of the fund would fall. The second, and the fixed income side, could clearly be credit risk, which we've seen play out, the last 4 or 5 years, where there have been defaults or delays in payments of bonds, and the NAV of your fund can take a hit. So I think investors need to be very, very cognizant of these risks that exist in funds, especially when they're inching closer to their goal date. Because if your goal is non-negotiable, you need that money at that point of time, you need to reduce the volatility or the risk of you not meeting your goal at the set period of time.
So this also brings to the question of having an exit time from a particular asset class in your investment. How should you time that? How should you strategize that?
Yeah, absolutely. And I think very, very important point that you raised, Kavita, because when we think about, when we do the goal planning, and I'm glad to see a lot of people are doing goal planning now, we always think about the entry strategy or the ongoing strategy, right? That, we have this goal, again, for example, say 10 years down the line, and I want to build, this is my horizon, this is my risk appetite. So I will build an asset allocation that meets this criteria, which is great. But what's important to acknowledge is that this asset allocation cannot be static at every point of time. Because as you start approaching your investment goal, like I outlined, there are these risks that could emanate at any point of time. No one can predict them. And you need to safeguard your portfolio against volatility from these risks, right? So the first thing that you should start thinking about, and it's a very popularly used tool abroad, which is called the glide path approach to investing. So essentially what you're trying to do through a glide path, and it's very similar to how you land an aeroplane, right? It starts reducing altitude, it starts cutting speed so it can make a safe landing, right? The same way with your portfolio, what you need to think about, we know equity, like I said, is a great long-term asset class, but it's volatile in the short term, right? So the first thing you need to start doing in terms of an exit strategy or stabilizing your portfolio is moving away from equity to a less volatile asset class, such as fixed income. And you should start doing that not just 1 month or 6 months or a year before. You should start gradually reducing that. So suppose you had a 10-year goal, you should make a glide path approach where maybe 3 years before your goal or 4 years before your goal, you will start reducing it gradually. As you approach your goal, your equity allocation would have come down quite significantly in certain cases, maybe even zero. It depends completely upon the goal that you have in mind. And moving it to a less volatile asset class like fixed income. And even within fixed income, you would want to get into fund categories which are much lesser prone to volatility and some of the risks that I explained in terms of interest rate risk or credit risk, so that your capital is reasonably safe. And in all likelihood, if you've planned well, you've probably already reached your goal amount well in advance. And you need to also put these assumptions into your calculation so that when you start with your investing amount and your journey and how much you're investing every month, you should kind of put that into the formula so that you invest enough. You can reduce volatility as you go along and still have the desired amount available to you when your goal date arrives.
One last question on this topic, and then we move on to Deepak Joshi, our viewer from Vadodara, who's online waiting. So what also a lot of investors do, Kaustubh, is even if they have enough time left for their goal and there's volatility in the market, they try to protect their profit by taking it out and investing it in a liquid fund or maybe somewhere, where maybe in their savings account as well. Is this strategy good, or again, reinvesting that amount at a market level might just take away the profit that you could have earned if you were stay put?
Yeah, absolutely. I think the strategy is actually a very wise strategy because you're trying to protect the capital, right? So if you've done your planning well, you've already reached your investment goal. I don't think investors should become overtly ambitious or greedy, saying that, if I wanted 10 lakhs and my portfolio value today is 15 lakhs, I want to let the equity allocation continue as is, right? Because if you have a year to go, for instance, in your portfolio, that 15 lakhs, if the market's corrects 30%, you'll come almost close to your goal level, and it could correct even further from there. So the safest thing to do is first protect your investment goal amount. The remaining, if you have some risk capital available because you invested very wisely, sure, you can continue to stay invested in equities. But I think, that individual math every investor needs to do. But the wise thing would be to protect your investment goal amount, kind of almost ring fence it in a way once you've already achieved your goals. I think that's a very good strategy to apply.
Interesting. All right. Let's move on to our viewers' queries now. Kaustubh, Deepak Joshi from Vadodara. Hi, Deepak. Good evening. How are you doing today?
Good evening, ma'am. I'm fine. How about you?
I'm doing good. Thank you. So your query is specifically on HDFC Balance Advantage Fund, right?
That's right.
Anything else?
No, that's it. That's what I wanted to know.
You're talking about a retirement corpus. I hope you have yourself well diversified for that particular goal.
Yeah, absolutely.
All right. So the fund in concern is HDFC Balance Advantage Fund, Kaustubh.
Yeah. So, a couple of thoughts, right? So, I'm not aware of, if this is the only fund within Mr. Joshi's
Trying to
portfolio.
ask him, yeah, which is what even I wanted to ask him, so that we could have given him a better strategy. So Deepak, is this the only fund in the portfolio?
No, so let me just give you a brief background so that you understand, my query better.
Sure.
So actually, I'm in investing since long, and I'm well diversified. I'm into funds, and I've got a reasonably decent corpus. So this particular query came from that, I am wanting to build a corpus for my retirement needs. The amount which I want, comes in the most tax efficient manner.
Okay.
So this is the background, because fixed deposits, etc. Even if they fetch you something like 7-8%, but would give you 30% tax.
Got it.
This would be a 10% tax.
So 50,000 only in this fund, or you have it in other funds also?
No, even in this fund, 50,000 is currently I'm investing, but there is a decent corpus already in place in this particular fund.
All right. Kaustubh.
Yeah. And if I may ask, Deepak, how far is that retirement goal in terms of number of years?
Maybe 6 years hence.
Okay, sure. So I think, just listening to this additional information that we have, so I think, in principle, the fund, and I think what Deepak's thought process is great, because what you're trying to do is you're trying to asset allocate through this, get an equity exposure, and even for your fixed income exposure, you get that tax arbitrage given the new tax regime that's come about. I think a couple of just observations or points that I want to make. Obviously, I think this fund has been a favorite with investors for a fairly long period of time, given that Prashant Jain used to manage it up until last year till he left, and obviously Gopal Agarwal, who's taken on, I think, a very good manager, no doubt. Just that his style is slightly different from Prashant's, but I don't per se see a problem with holding the fund as an individual strategy at all. I think the only thing that thought that I would leave with Deepak to kind of ponder over is 6 years is a reasonable time frame, maybe because this fund would typically vacillate between 60% to 80% net equity exposure, and depending on his own sort of requirements, if he's already got some corpus in place which can take care of his retirement, he can potentially be a little more aggressive with the strategies, is my only thought. Maybe add on some equity exposure. If his asset allocation allows exposure beyond 60, I think that's something that's worth thinking about. But otherwise, standalone of the fund, that's good. If you've taken care of all your other needs, I would probably encourage, like I said, to think about a little more equity exposure if this is something that you're going to think about a little further down the line.
All right, we move on to our next question. Kaustubh, that is from Dr. S.N. Reddy, and he says that he would like to invest 10 lakhs in mutual funds, and he wants you to suggest at least 5 to 6 good performing mutual funds. Yeah,
so I think the information honestly is a little. It's a pretty wide scope sort of question, because we don't know what his...
Exactly. So we wanted to have him on the phone call, but then he's not available. So how can we guide him?
Yeah, so I think he'll need to think about a few things, and I can just put some broad pointers about what he needs to think about. And just alluding to the earlier sort of suggestion is that what's his time horizon, right? That he wants to invest this time over. Is it 1 year? Is it 3 years? Is it 5 years? Is it 10 years? Because that's really going to decide the overarching asset allocation that he has in mind. Typically, if it's just a year or two, then you would want to get into the more liquid fixed income sort of categories with limited duration or interest, credit risk. If it's, between 3 to 5 years, you can add on some equity exposure, but not to, fixed income would still be a large part of the portfolio. As you start reaching that 5, 7, 10-year mark, you can become a very equity heavy investor, even going up to 80, 90% if you have a 10 plus year horizon, right? So I think that's the first thing that he needs to keep in mind with his corpus. Obviously, if he's going to be investing into equities and he's got a long investment horizon, I would still recommend to avoid that sort of, market timing risk. If you have that quantum available of 10 lakhs, split that into maybe over the next 6 to 12 months. rather than doing it in one shot. If it's largely going to equity funds, I think that's something that he needs to keep in mind. And then when you build a portfolio of funds, be it fixed income or equity, pick diversifying styles within that, especially on the equity side, amongst the various managers or the strategies you can buy. So you'll have your growth managers, you'll have your more, sort of GARP managers and value managers. Look to buy portfolios that are not very similar in their holdings so that you can get effective diversification within your portfolio. So I think these are just some broad rules that Dr. Reddy needs to look at.
Yeah. And for a specific recommendation, maybe he needs to give us more information. But on that note, thank you so much, Kaustubh, for being on the show and helping our viewers with their financial portfolio and their investments today.
My pleasure. Thank you.
We move on. As part of IDFC's First Bank's Leader of Tomorrow Season 11 industry-specific deep dive, we highlighted two key players in India's travel and hospitality sector. In the first segment, Amanpreet Singh Bajaj, General Manager of Airbnb India, discussed the surging popularity of homestays and shared his insights on the future of India's travel and hospitality sector. In the second segment, Alok Bajpai, co-founder and Group CEO of Ixico, provided an overview of the travel aggregators' plans for the Indian market and also shed light on the increasing demand of experiential travel among Indian consumers.